Welcome back. Stocks ended on a high note today following what can only be described as a quite volatile week of trading, linked, among other things, President Trump's policy on tariffs. William D. Cohan joins me now. He is the co-founder and Wall Street author for Puck, which I subscribe to and highly recommend. William D. Cohan, I'll call you Bill for our conversation. You wrote something this week that I want to talk to our audience about because it explains the story behind the equity markets. And I want to read this. You are familiar with it, but I want my audience to be familiar with it. Forget the equity markets for a moment. The more telling signal of the coming financial calamity can be found in the bond market. Let me continue. After all, when people start freaking out about whether they'll get their money back as contractually agreed by the government or by corporations, while also worrying about receiving contractually agreed interest payments, the S, and I have to use that, S really starts hitting the fan. Explain.
Well, the bond market, first of all, Major, thank you for having me. It's a pleasure to be here. And people don't really understand the bond market as well because, first of all, it doesn't get nearly the attention that the equity markets get. CNBC and others are not going on every day and talking about, individual bonds and how they're trading. But the bond market is where you go to determine how much risk people are interested in taking, what they are fearing about whether or not they're going to get paid back for the money they lend, whether money can even be lent because when interest rates get very high or whether there's a credit freeze. And our whole economy runs, the grease of our economy is the bond market, is the credit market, is the loan market, is banks lending, it's institutions lending, it's investors lending. And if that pricing gets out of whack, as it did in the last week, or if it begins to dry up, as it has many times over the last, in the history of this country, it really leads very quickly to bankruptcies and recessions and people not being able to get access to the credit that they need to, say, buy a home, buy a car, buy appliances, buy the things that they borrow money to buy. And when that money begins to dry up, then the gears of the economy get gummed up very quickly.
And Bill, from your vantage point, was it the instability in the bond markets or the signals that were being sent that were somewhat alarming to the White House that led to the president imposing the pause on all trading partners except China?
Well, that's what I understand to be the case. It's hard to know exactly what's in Donald Trump's mind and why he does certain things. But at first, Major, I think it's important to say that after he announced these tariffs last Wednesday, that there was a flight to quality, and bonds actually traded up, and the yield traded down. And then it quickly reversed, and we had a major reversal in the Treasury market with the yield on the 10-year Treasury getting up to 4.5% from below 4%. It's a very big move in a very short amount of time, and that's just the safest market, right? If you look at the yield on the high yield market, the junk bond market, the average yield in that market moved to 8.5%. From 7.5%, another major big move up. And basically, those are just red flags about investors and creditors getting very nervous about whether they're going to get repaid, whether they're going to be defaults, whether they're going to be bankruptcies, and very reluctant to lend money into that market because there's so much uncertainty. And again, the last thing we can stand at this point is a credit crunch or a credit freeze where the sources of capital being lent to people dry up and can't get access to that really at any price or any affordable price. And that just leads quickly to recessions.
And Bill, two things happened this week. We had two inflation prints, that's the terminology, but inflation numbers that suggested it was cooling and becoming a little bit more manageable, economically speaking. Then we had the University of Michigan Consumer Confidence Survey showing expectations for future inflation as high as they've been since November, brace yourself, of 1981. Which of those two is more important as far as you're looking into the future?
Well, unfortunately, it's the University of Michigan forward-looking inflation number. The inflation numbers we just got, as one of your previous guests said, were pre-tariff. And yes, pre-tariff inflation numbers were coming down in the first quarter and in March, and actually, began to restore consumer confidence. But very quickly, even 2 weeks before the tariffs, I had a piece New York Times op-ed where I talked about what was ended up happening, unfortunately, where consumer confidence was already beginning to crack, and you see this now post-tariff, where people's expectation is that inflation is going to rise, and it's not just like pie in the sky. I don't like Donald Trump. I think inflation is going to rise. It's you put 145% tariffs on imported goods from our third largest trading partner, you're going to see prices rise, and especially at places like Walmart, where a large majority of what they sell is imported goods, and that's going to come into play very quickly.
Bill Cohan, I appreciate it. I hope you'll come back.
Thank you, Major. Really appreciate it too.